The central banks around the world, they want to control how, when, and where you'll spend your money. US Treasury, they are going bankrupt and are now announcing they want to start their own bond buying program. So when the Federal Reserve is stopping buying bonds, while the US Treasury is wanting to come in there and bail out the markets. And BlackRock says the UK financial system failing is just the first of many things to fail in the markets coming ahead. So everyone, this is definitely going to be a good one. Let's not waste any time, ladies and gentlemen. Let's get straight into the news, the facts, and the data. Look at this, everyone. This is terrifying. Central bank digital currencies would let government control what people spend money on. IMF, this is the International Monetary Fund, official admits. Now, there's been a big push lately for these central bank digital currencies. They're trying to say how great it'll be, it'll create more equality, it'll create more financial inclusion. Really, all it is and what it'll do is create more central control for the central banks, which they already have so much control over the financial system. They can create a boom, and like we're seeing now, they can create a bust. We're not in a free market economy. These central banks are 100% running the show. Lee, who stepped into the role of Deputy Manager Director at the IMF on August 23, 2021, added that by allowing governments to precisely target what people need, this will enable said government to improve financial inclusion. So on the surface it sounds great, but when you give government control on what people can and cannot do, sometimes they overstep. And now people are coming out and sounding the alarm on how bad this could really go. Nick Anthony, a policy analyst at Cato Institute Center for Monetary and Financial Alternatives, Anthony wrote on a Twitter that the IMF executive's comments reveal how a CBDC would allow the government to precisely control what people can and cannot spend their money on. In a follow-up post on Twitter, Anthony quoted a comment made by Neil Kashkari, president of the Federal Reserve Bank of Minneapolis, writing, "I can see how China is for this. I don't see how Americans would want this." And that's exactly right. We see a lot of central control in China about how people spend their money. We see the social credit scores. We see the huge invasion of people's privacy in China. They have apps now where the government completely controls people's movement. Green, yes, you can go outside and participate in the economy. Red, no, you're a prisoner to your home. And they go on to warn that the government does have a pattern of misusing these tools, kind of like the trucker protests in Canada, where people had their bank accounts frozen and even people that tried to donate had their bank accounts frozen. So you can imagine how bad the financial tyranny could go if we do go to a full-on cashless society. A May report from the Bank of International Settlements, that's pretty much the central banker for the central banks, the BIS, found that almost 90% of national central banks are planning to launch their own CBDC for release to the general public. Now, people, I don't know about you, but I remember if you even mentioned that there's going to be a centrally controlled digital currency, a central bank digital currency, and cash was going to be wiped out and we'll enter a cashless society. If you even mentioned this 3 or 4 years ago, people will call you a crazy conspiracy theorist. Well, now 90% of central banks around the world are trying to figure out a way they can implement it. However, critics fear CBDCs will increase government control over money that could be used as a tool for financial discrimination, while simultaneously tracking purchases and restricting access to funds, thereby working against decentralization, which is one of the main advantages of adopting cryptocurrency. That's exactly right. The big push for the central bank digital currency came out when we saw the popularity of cryptocurrencies rise, like Bitcoin and Ethereum and other trending altcoins. But the whole point of Bitcoin was to create a decentralized currency that didn't have a central entity controlling it, and this is going to be the opposite. So I don't think you're going to see a lot of cryptocurrency investors take up these central bank digital currencies. Austin Carstens, general manager of the BIS, noted in 2021 that central banks would have absolute control over the rules and regulations that will determine the use of that expression of the central bank liability, and then will also have the technology to enforce that. Again, people, they're admitting here they will have complete 100% control over these currencies. You won't have any freedom what to do with this money whatsoever. They're not even trying to cover up or hide it. Federal Reserve Chairman Jerome Powell last month also noted that a CBDC would not be anonymous and would be identity verified, meaning details regarding transactions of a CBDC would be public. The European Central Bank (ECB) President Christine Lagarde stated there would not be complete anonymity as there is with banknotes. So that's the thing with cash. You can still transact privately or not have it tracked on some central bank ledger. And some people don't trust the banking institutions They're afraid that they may have their money bailed in. They're afraid the financial institution may fail. They should have the right and freedom to hold their own cash if they want to. So people, it's not a conspiracy anymore. These central banks want to create this central bank digital currency so they have full control over your financial life. And this means the global economy could become more and more controlled. For example, they can say, okay, we're creating this central bank digital currency, but you can only spend it at these industries that go along with ESG, that go along with our political agenda, etc. Even today, we're seeing a lot of companies, if people say something that's politically incorrect, they're having all their bank accounts frozen, they're having all their social media accounts cancelled. It is terrifying with how much central control these monopolies have over people's lives right now. And this is why we can't let them create this central bank digital currency, everyone, because it'll give them uncontrollable power that we'll never get back. Now, also something that's going to make the markets more centrally controlled and is quite alarming, the US Treasury is getting very close to going bankrupt. They're in $31 trillion of debt, and like I said, this is going to be catastrophic for the US government with now the 10-year US Treasury yield over 4%. And so the Treasury Department, Janet Yellen, she's starting to panic, and they're now thinking about starting to buy US government bonds when a central bank is meant to be selling them. Look at this. Momentum builds for creating a Treasury bond buyback program. Dealers have been asked for their opinion on how to structure one. Bank of America strategists predict a May 2023 rollout. So again, people, like I always say, the banks are running the show. We like to think our governments are running the show here, but we see again and again the government are going to the banks and asking them, what should we do? Liquidity metrics for US government debt markets are approaching crisis levels after a year of steep losses for bonds caused by rising inflation and the Federal Reserve interest rate increases, and with the central bank simultaneously cutting some of its holdings, the situation may worsen. Treasury Secretary Janet Yellen expressed concern about it last week. So pretty much what it's saying there is, you know how we saw the crisis in the UK bond market where yields started to spike to crisis levels? Same thing is starting to happen in the US bond market. And this is the reason why we need to pay attention to this, everyone. The bond market is valued at $46 trillion. So if something blows up in the bond market, we're going to see severe pain. And look at this, the iShares 20 plus Treasury Yield Bond ETF. This is a ETF for 20-year plus Treasury bonds. And we can see it is down 43% from its peak in April 2020. Also, we've got another chart here. Yields on the 10-year US Treasury yield have just hit a new recent high of 4.13%. So although 30-year fixed rate mortgages are going to be well over 7% now, and I think we're going to be approaching 8% very, very soon. When warned last week that Treasury buybacks might begin to enter the debt management conversation, we didn't expect them to jump so abruptly into the limelight. So that's right, they wanted to keep this hush-hush under the cover. They didn't want the public to know because people, they are in a panic. September's liquidity strains may have sharpened the Treasury's interest in buybacks, but this is not just a knee-jerk response to recent market developments. I think it is. And this is absolutely crazy, people. What this is like is, for example, someone's got their credit card, they've maxed out their credit card, interest rates on that credit card have spiked to, say, for example, 25%, and they're going, actually, there's no way we can afford to repay the interest and the principal back on this credit card. So what should we do? I know, we'll just go get another credit card to pay back the credit card that we can't afford to pay back. This is exactly what the US government is doing right now. And we're all about to pay the price for this because guess what's going to come next? Higher and higher taxes. And the problem with higher taxes and unlimited spending, or someone that has a spending problem, or someone that has a debt problem, it doesn't matter how much you make. If you keep on spending more than you bring in, you're always never going to have enough. You could lift taxes to 100%, but if the government keeps on spending more than it brings in, taking 100% of people's money still won't be enough. And this has actually happened before during the dot-com boom and bust. The buybacks in 2000 and 2002 were done to allow the Treasury to continue to sell new bonds to maintain its market access at a time when the federal government was running a budget surplus and didn't need the money. Funds were raised by selling new bonds and were used to repurchase the old ones. So what they're pretty much going to do is issue bills, issue short-term debt to try to bring down the cost of the longer-term debt. And the last time they did this, the US Treasury was in a surplus, but now they're in a deficit. So they really can't afford to do this. But again, they're just trying to buy some time any way they can. Under the current circumstances, which include a large federal deficit, a buyback program would have a different purpose. They include adding liquidity to parts of the market most in need of it and allowing treasury bills to be sold in more consistent quantities, with the proceeds used for buybacks of securities less in demand. So again, what this simply means is they'll issue more short-term debt, they'll sell more bills, and they'll try to find a way where there's illiquidity in, for example, the 10-year, the 20-year, 30-year, etc., and then they'll go ahead and buy those bonds, which again is going complete opposite to what the Federal Reserve is doing. And this is what the UK government tried to do. They tried to announce more fiscal stimulus, and we saw what happened to the Chancellor in the UK. He got the sack. People have completely lost faith in Liz Truss's government. And I think if Janet Yellen goes ahead with this, people are going to have less and less faith in this current administration. And people, you may be asking, why are they doing this? Why are they rushing to create a central bank digital currency? Why is the US Treasury going to buy bonds? Well, BlackRock may be able to paint the picture for us because we are in the middle of a full-blown financial crisis. You just don't know it yet. But when we look back at this time in history, we will know it was a Lehman moment-like event. Look at this, BlackRock Miller sees more stress in leverage markets post-UK. Central banks tightening means things are going to break. So what this means is, everybody, every single time central banks tighten their balance sheets, when they lift interest rates, when they start selling off bonds, selling off assets on their balance sheet, we always see something in the financial system break. Like what we saw in 2018 and 2019 in the repo market, where overnight interest rates spiked from 2% to 10%, I think it's only a matter of time before we see something break in the US financial system like we did in the UK financial system. He warns, when you tighten financial conditions this aggressively, this abruptly, things are going to break. Where do they break first? Almost always in a leverage strategy. And this is what we saw in the UK market with the pension funds. They had extreme leverage and they almost got margin called and got completely wiped out. And I think it's only a matter of time before we see some leverage exposed in the US financial system. And that's why I think the plunge protection team is trying so hard to protect the S&P 500 from falling 30%, because we see right now it's down around 25%. If it falls 30% plus, that's when we can start to see some margin calls, because most banks will lend up to 70% of people's portfolio. This year, interest rate increases from inflation fighting central banks led by the US Federal Reserve are causing borrowing costs to rise worldwide. Even high quality companies are being forced to pay higher than anticipated rates. That's exactly right, everyone. We're going to see these corporations that have taken on mountains and mountains of debt over the past 10 years, they're going to get exposed. All these corporations that took on huge amounts of debt to buy back their stocks, well, maybe it made sense when interest rates were 2%. Or if interest rates for these loans go into 7, 8% and their stocks keep falling, it's not going to make sense at all anymore. And we may see some of these corporations get margin called. The all-in cost of capital has gone up substantially in the investment grade space. You're talking about an index that's now a 6% yield, he said. In the high yield space, you've got some companies that were funding a year and a half ago at 4 to 5% that now can't get funded inside of 10% and may not be able to get funded at all. So what BlackRock is saying here is there was companies that a year or a year and a half ago that were maybe a high credit risk, they could get interest rates of 4 or 5%. Well, now they can't even get interest rates at 10%, and some are not even getting funding at all. So what this means is we're going to see more corporations go bankrupt over the next 1 to 2 years. We're already seeing companies announce massive layoffs. Microsoft even just announced layoffs recently. So things are going to get worse. So everyone, I know what you're thinking, okay, what does all this financial jargon mean for you in simple terms? Well, one, this means we can't allow the central banks to create a central bank digital currency because you'll lose full control over your financial life. The US government is going bankrupt and they're now trying to bail out the bond market. And third, BlackRock is saying we're seeing more pain in the corporate debt bond market. There's going to be more corporations maybe go bust with its higher interest rates. So conclusion, even though the market has been green a couple of days, this is just volatility, everyone. This is just algorithms trading. There was huge amounts of puts in the market. There was huge amounts of people going short. Every time this happens, when there's 3 times people short compared to 3 times people long, well, there's always a short squeeze. People see this on Wall Street and they take advantage of it. So everyone, what do you think about this? Let me know down below. Now, for all my loyal viewers and subscribers still watching, you're awesome. Thanks for watching. I'll see you all in the next video.